Hello and welcome to this Evaluate webinar, Tricky Terrain, Navigating the Pharma Investment Landscape. I'm Rebecca Brooks and I'm your host for today's session. Before we begin, I'd like to introduce our speakers for today. Paul Verdin is VP, Head of Consulting and Analytics at Evaluate, who has more than 15 years of experience in life sciences, academia and consulting. Jen Baydar is Evaluate's Chief Consulting Officer, and he works closely with pharma organizations and investment companies to help them make the best decisions for their companies. We are also joined today by Özgür Tuncer, who is an investment partner at Ascension Life Fund. He is also CEO of Stable Pharma, a UK-based biotech firm, and has a wealth of experience in strategy, M&A, and investments in the biopharmaceutical industry. Before we begin, there are a couple of housekeeping points to cover. Firstly, the webinar should last for around 30 to 40 minutes, and it is being recorded, so we will share a link to that recording along with the slides. Please do ask questions as we go through the session, and we'll try to answer as many of them as possible. Any we aren't able to answer, we'll follow up with a little later. You can ask questions through the platform via the Ask a Question section towards the bottom of your screen. If your question is for one of the speakers, please indicate this at the start of your question. Now, I'll hand over to Paul, who's going to give us an overview of the current investment landscape. Over to you, Paul.
Great, thank you, Rebecca. Good morning, afternoon, evening, everyone, wherever you might be calling in from. Thanks a lot for taking the time to join us here today. So my name is Paul. I'm going to take us through the first part of the section of the webinar here today, and then I'll hand over to Özgür and Jem for the second part. So we've got some analysis we'd like to talk through, and as you saw, the title of the webinar today is Tricky Terrain, which perhaps is very apt, as you'll see as we go through the analysis that we've got for the webinar here today. So the first slide that I wanted to show you all was in relation to sales. So this slide here that you can see on screen is portraying the industry in terms of top line sales from 2017 through to 2026. And I think the first thing to say, as you can see, is that this is portraying an industry in very, very strong health. Pharma is an industry growing from top line sales of around 800 billion in 2017 through to a forecast based on the sell side consensus that we have here of around 1.4 trillion by 2026. So really a phenomenal growth story, and you can see the growth rates displayed on the slide. So this is really testament to the industry's ability to deliver on innovation and to drive improved patient outcomes and also value generation from that innovation. And if we look at that index through time, this is showing the shape of that forecast trend, if you like, indexed to 2020, with some snapshots through the Evaluate database back through around the last year or so. And what you can see is that trajectory has really not changed. If anything, it's ever so slightly increased. So it's a very consistent picture and consistent image of growth for the industry, which is actually across the board, across pretty much all therapy areas where innovation is driving growth. So from a sales perspective, the industry is in a very sort of strong position. But of course, nothing is ever that simple, and we know that there's a lot of sort of turbulence really in the macroeconomic climate right now, and pharma is for sure not immune from that impact. And so moving on to look at stock performance, and this is looking at a group of around 700 companies that we track in Evaluate databases. And you can see here what this slide is showing is that Q1, we saw a huge decline, more than $200 billion, wiped off the market cap of those 700 or so pharma companies. And that was far in excess of anything we've seen in recent times, certainly much greater than anything that we saw last year when the biggest quarterly decline was much smaller. And it's also something that's most certainly been maintained through into Q2 with the NASDAQ Biotech Index, for example, continuing to trade down quite substantially year to date. So kind of tough times really on the public markets. And if we dig into that and look at that breakdown by segment within pharma, by company size, we see that sort of pain, if you like, is being felt across the board, everywhere except the big pharma segment, which I guess, traditionally a kind of safe haven or a sort of steady ship in a storm. But outside big pharma, we're seeing declines across all segments. Actually, within the large cap segment, more than half of companies in that segment declined in Q1. And just by way of a couple of examples, Moderna and BioNTech, which pretty much become household names really, given their contribution to the COVID response, both are involved in that and lost a combined $55 billion in market cap value in Q1. And that slide for both companies indicative of the rest of the sector in continuing through into Q2. Within the mid cap stocks, 75% declined, and within small cap, around 80%. Trading down year to date, as have a number of closely watched ETFs that track different segments of the industry. So substantial swathes of the industry really are trading below cash in this environment, and macroeconomic conditions are not favourable across the board, but certainly not for pharma. So pretty tough times on the public markets, and this chart shows that in the sort of percentage-wise drop, so you can see the scale of the decline in Q1. But moving on, another sort of bellwether metric, if you like, for the industry is M&A. And this chart here is showing quarterly M&A deal values for the last couple of years. And 2021 was one of the worst years on record for M&A in pharma. So, obviously not a great situation. But a bit of a pickup towards the end of the year had spurred hopes that perhaps we'd see that sort of, I guess, much looked for recovery moving through into 2022, but that didn't happen in Q1. So Q1 transaction volumes were at a 5-year low. So really, M&A it's still very muted. And actually moving into Q2, I think we can say the same. There have been some signs of renewed activity with companies like Pfizer, for example, making a number of acquisitions, including, for example, the Biohaven acquisition, a notable big deal of the year so far. But still very, very muted, and actually relatively little sign of acquisition of public companies year to date, which is unlikely to act as a catalyst to bring investors back to the sector either. And this sort of dearth, if you like, of takeouts, also showing that depressed valuation hasn't really been the driver of M&A so far in sort of recent times, which perhaps was a school of thought around what might drive a turnaround in M&A towards the end of last year. So what's sort of holding the industry back on the M&A front? Access to cash is not likely to be a driver. We know pharma, is cash rich and also makes strategic acquisitions when the time is right, almost regardless of the sort of economic backdrop. So perhaps the brakes are more being applied from the sell side with target companies that are generally well cashed up to continue operations and less interested in selling or moving on while valuations are relatively low. So moving on again to another one of those sort of bellwether metrics is this chart here is showing IPO trends and in terms of raisings and a number of IPOs by quarter again for the last few years. And I think after much crystal ball gazing, we can probably with some confidence say that the biotech IPO window does appear to be closing. We can see a marked drop in public offerings in Q1, which is actually the lowest since the beginning of 2020, Q1 2020. And that's back, of course, when emergence of the COVID pandemic was a major compounding factor. Now, in recent times, I guess many observers have lamented the flow of, in inverted commas, low-quality companies onto the public markets. So perhaps a slowdown in IPO is not such a bad thing for the sector as a whole. But what we certainly can say is that the macroeconomic climate is not predictive that this is a temporary blip. It certainly looks likely to entrench and sort of stay muted for some time. But I guess all we'll be hoping that the window doesn't close entirely, because we know innovation is really a lifeblood of the industry. And for companies that did manage to get away during Q1 of this year, those companies had to contend with ever-deepening price discounts. This chart is showing the premium or discount to IPO list pricing, which is pretty much at the lowest point, as you can see, in Q1 of this year since the end of 2018. So tough times as well for companies that are seeking to IPO and investors that are seeking to exit via that route. But one area that certainly is not on the decline is venture financing. And this chart here is showing quarterly transaction volumes and amount raised through VC investment. And as you can see, Q1 was a very strong quarter, even compared against the recent trend. You can see the figure there of somewhere around 8 billion raised by our analysis here. And can this continue? I think the general consensus is yes, it can. Funds are well stocked. There is an appetite to invest in innovative next generation technologies or innovative pharma companies. So there is this general consensus that yes, this can continue. I think there are signs that there's potentially a little bit of a slower level of activity into Q2, perhaps reflecting a slightly more cautious stance, being filtering down from the macro market conditions. And we know that investors clearly will want exits from their investments. So with the public markets, with M&A, with IPO, with that whole scene such as it is, there's some sort of contradiction in terms there, I guess. But we know that pharma is very cyclical, and investors that are not focused on the short term, that are more focused on the long term, probably less directly concerned by those immediate sort of macroeconomic conditions right now. And what we certainly can say is that there is a very large supply of potential investment opportunities. And this chart here is showing the number of private biopharma companies by stage of their most advanced asset. And we can see a very large and sort of healthy pipeline of private companies moving through R&D. And versus 12 months ago, this has actually expanded a little, so sort of reflective of company creation and sort of investment opportunities. So the high-level message is that innovation is still very much a driving force of the industry, and this crop of private biotechs developing that next generation of innovations is just as strong as ever. Now, some recent analysis by Evaluate's Vantage team is quite interesting, and that highlighted in recent years a relative sort of increase in representation of new blockbuster launches coming from internally derived programs. So rather than through acquired innovation, more from internal R&D. So it remains to be seen if that's really a fundamental shift in the industry, but nonetheless, it does make it more important than ever for smaller developers and investors to only back the most high quality assets. So I'm just going to wrap up this first part of the webinar here today with a quick summary and our perspective. So, of course, complex pressures weigh on biopharma, but the sector continues to deliver innovation and growth. Of course, there are headwinds facing the industry today. The closure of the IPO window, muted M&A, tough market conditions are good examples of that. But clearly tailwinds too. Biopharma's capacity to deliver on innovation was clearly demonstrated during COVID. Venture financing remains very buoyant, and there is a very strong supply of private biopharma investment opportunities. So on the whole, uncertainty, but opportunities for investors to deploy capital in what is clearly a very high growth industry are plentiful. And as ever, making the right investment choices should be based on differentiation and a solid value proposition for the asset or the company in question. So thank you very much for listening. I'm going to hand over now to Özgür and Jem for the second part of the session.
Thank you, Paul. Now, Jem and Özgür will share their views on some of the key investment trends.
Thank you, Paul. Thank you, Rebecca. Özgür, thanks for joining us today. It's a pleasure to have you here. You are an investment partner at a VC, investing in early stage opportunities across Europe. Despite the market conditions at the moment, are you investing in actively? And then my next question would be, where do you see the opportunities in the next 12 months? Maybe we could start with a brief introduction about yourself, and then you could share your thoughts about this provider context. Thank you.
Yes, thank you, Jam. Thanks for having me. I think Rebecca has done a fantastic introduction of me. I'm an investment partner at Ascension Life Fund, which is an early investor in healthcare and life sciences and technology. I'm also CEO of a biotech company called Stable Pharma, and I've worked for big pharma and big CROs and for boutique consulting firms before as well. So I've been around for some time, or enough to basically take a look at the situation, maybe from a couple of decades perspective, Jeff. But so your first question about are we still investing? I mean, it's pretty much business as usual, I think, for Ascension Life Fund. And as far as I can see, for most of the early investors, and even some of the later stage investors, there are a couple of reasons for that. I think one of the reasons is that, as Paul said, the industry has a very long-term view. So the investments we are looking at are, at the minimum 5 to 7 year investments, perhaps even longer term. So you cannot just be focused on the current market situation. So that's one of the reasons. The other reason I think Paul also mentioned, which is that there's a lot of capital out there, private capital. So even though there are some restrictions in public capital, or public capital is moving away from the markets, there's a lot of dry powder in private capital. So we continue to invest. I think what happens in these situations is, I think it gets reflected on two things, really. I think the first is typically on the valuations, and people are much more careful about valuations, of course, because the public benchmarks are different. And secondly, of course, they're a lot more careful about due diligence, and not that they're not usually careful, but they pick and choose a bit more, I think, in these type of situations, rather than situations where there's abundance. The other question you asked is what do you see as interesting or hot areas? And let me answer that as well. I think from my perspective, I think the industry is going through a lot of very positive change and innovation. I mean, there's a lot of interesting things out there. Of course, everybody knows about now the new mRNA paradigm and mRNA technologies, which is fantastic. There's, of course, gene and cell therapies that are increasingly coming to market, despite some of their challenges in manufacturing. Digital technology and AI is penetrating into the market. And in fact, in Ascension Life Fund, that's, as you know, we invest more in the intersection of AI technology and life sciences. So that is very interesting. Oncology, of course, as a therapeutic area, is always a very happening, crowded area. So yeah, I mean, I think all of these pockets, and there's a lot of innovation at the moment.
No, great. I mean, it's great to hear that. Thank you. It's very encouraging. And also, we also see a lot of biotechs, as you said, shifted their research programs to mRNA and vaccines lately, especially, to get a solid pipeline and funding. We also see it is becoming an interest of CDMOs as well. So it's not only the biotech, but also looking at it from the supply and demand perspective.
One thing that's happening, Jam, on the vaccines front, which I think is also quite interesting, is that, back from my Pfizer days, I've always kind of advocated this, but it seems to be catching up with the industry now. People thought about vaccines as just kind of prophylactic, preventative medicine. But what's happening now, increasingly so, is that they're actually looking at vaccines as therapeutic interventions. And I think that's the big change in how people think about vaccines, and I think that's going to hopefully continue right in the next decade.
No, makes sense actually, and maybe the other thing that we could turn our attention is the geographic differences. As you see, we are going through this change or interesting times. There has been a continuous discussion lately. So, what are the differences that you see, both from the investment sizes, the typical investment strategy and opportunities between the US, EU, and the rest of the world?
Rest of the world. I mean, I think it's very interesting. Of course, US is always the biggest market. There's a lot happening in the US, and I don't think that dynamic has changed or shifted materially. I think one of the things that's more and more interesting is UK, actually, because if you look at the track record in the past couple of years, UK is becoming really the major innovation hub in Europe, and in terms of biotech investments, definitely the leading hub in Europe. And it continues to actually grow that position. And in Ascension Life Fund, we do invest specifically, as you know, in the UK innovation. I think the other dynamic, and of course, rest of the Europe is also picking up and picking up some of that investment. The other thing that happens, you and I very well know from our years of experience, is in difficult times like this, the money runs away from emerging markets sometimes, and I think we're probably seeing a similar type of cycle now. I think money is mostly going into more, safe or secure geographies, as you would expect. So I think US and UK definitely on top of the list, with other European markets, of course, and there are other pockets like Israel and other places where innovation is obviously booming. So
no, absolutely, and I guess and again, if you look at the trends, the success rates, and so on, I mean, especially if you look at the past ASCO presentation outcomes of it, I guess the innovation is out there, right? I mean, you cannot deny the fact that there are good things happening from the research perspective or R&D perspective. But there's also
it is unprecedented, I think, Jam. I can't emphasize more that it is unprecedented. And the reason why I think it is unprecedented for somebody like myself, who has been in the industry for a very long time, if you think about what happened in the industry in early 2000s, innovation was really kind of small molecules, right? That was the innovation. And then, biologics were just kind of coming to market. Anti-TNFs were just launching at the time, but there wasn't a richness of different technologies, right, in our industry. It was actually quite basic. What's happening now, which makes me very excited, is that, again, that technology really changing the game. So you have so many different technologies, again, be it the mRNA or DNA-based technologies or cell therapies or gene therapies and digital interventions. I think it became so much richer, the industry, and ASCO, of course, some of the oncology results we're getting and all of that is very, very exciting. But I think, to me, that's probably one of the most exciting things that's happening. It's multifaceted.
It is indeed, because I mean, when you talk about gene editing, I guess the question becomes like, we keep saying, what type of gene editing technology are you talking about? It's not like the gene editing itself. Now it goes into different fragments and different advancements in those applying that technology. So it's really fascinating, actually. When you're talking about gene editing, people start asking about the details of or the types of gene editing that the new technology is about. But there's also an interesting, fact, because there was also Bio, as you know, I think it was 2 weeks ago, Bio International.
2 weeks ago, yeah.
Yeah, and then we noticed that, and obviously, that was also a discussion. If you look at the public markets right now, the biotechs, there's an interesting dilemma. I mean, if you look at the market cap of biotechs, unfortunately, 1/3 of them, I guess, their market cap is lower than the cash that they have at the moment, which is an interesting.
Yes.
Interesting.
Same discussion last week at the BIA Bioindustry Association CEO Summit in the UK, which I attended with many fantastic biotech CEOs. Same discussion. I mean, I think what happened, and it is true, there's so many companies now, I forgot the number of companies, but I think there's something like 100 plus companies who are trading below their cash at hand at the moment, right? So they're valuation, market valuation is below their cash. And what happened was, and this kind of links back to what happened over the past years with the pandemic, is we've seen a boom in biotech and in healthcare and in life sciences. There was so much money coming into the industry, and people managed to raise really at very healthy valuations, right, in the past couple of years. And of course, they managed to keep that money and do great things with it. But what ends up happening is then when you have a correction in the market, or maybe correction is not the right word, but back to normal. So it's not kind of COVID boosted markets, if you will. Then of course you end up in that situation. So that I think that's what's happening with those companies.
Yeah, and that might be temporary, as you said, and maybe finally. A final question from our end, because we would like to spend some time with answering some of the questions that we received as well. But what would you recommend to early stage companies which are interested in obtaining investment?
Yes, I mean, I think my recommendation always is with investments, you never know where it's going to come from. So you have to talk to a lot of people to find your investment. And in some ways, I describe it as you have to kiss a lot of frogs to find your prince who's going to support you in your journey. And you have to take the money wherever it might come from, Jam. You cannot really be very picky in this environment. But I think the other thing I recommend is, of course, people making sure that they have the cover to weather the storm as much as possible. I think the next 12 to 18 months is going to be tough, right? It's not going to be easy, but also make sure that they go back to their plans. And, I'm not advocating they should slow down or they should stop programs, but just go back and really have a kind of hard thought about how they want to prioritize their activities, basically, right? With the available resources and available cash. And I think everybody has to do that. But as I said, there are companies who have more cash than their market valuation at the moment. So those companies might be absolutely fine.
Yeah, I think that's a very good point. Thank you, Özgür. It was a true pleasure to have your perspectives. I think in conclusion,
thank you, Jam.
We can all agree with the fact that science always wins. So probably, if both from the investor's perspective and from the biotech's perspective, if it is the fact that we should be more focusing on the factual clinical results rather than the ones with long-term speculation, everything should be fine, hopefully. And actually, we started seeing some investment lately. I mean, I guess, within the last few weeks, there have been some announcements from Sanofi, Pfizer, Ipsen, and many others in terms of really looking into the scientific impactful biotech companies and acquiring them. So
there's no reason why that activity should stop, right?
I think so, and it's just a matter of probably weathering this storm with what you have in hand, and then obviously looking for opportunities, maybe joint collaboration with other biotech companies, or looking some innovative ways of funding the key pivotal clinical trials and so on and so forth. But rest assured, the biotech industry has been going through some depression for a year and a half, so longer than what we started seeing from the beginning of this year. So one could speculate the fact that it will be mean reverting sooner than later compared to the rest of the world, as it has been going through this for a while, and we can all be hopeful for that one, probably, and then see what's going to happen in the future.
Exactly, Jam. And the other thing that you mentioned, sorry, I want to emphasize that for people, but collaboration is key in our industry. And these are the times where everybody should really look for more collaboration to get things done, basically, right?
No, thank you. Very well noted. Thank you. So I will turn back to Rebecca. And
yes, thank you both, Jem and Oscar, for your insights. And we do have time for a couple of questions. So the first one is for Oscar. Do you see the multipolar nature of investment worsening in the short term, with Europe and the rest of the world continuing to lag behind the US? Progress in Europe had been positive in recent years. What will the role of Chinese companies play as an emergent market for innovators?
Yeah, that's a good question. I think well, I think we all know that Europe has and UK and Europe in general has a lot to do in terms of catching up with US investments. So I don't think Rebecca, anybody can claim that UK and Europe are Europe in general is close to US levels of investment. But I would say that the gap is actually closing quite quickly. I think, especially in the case of some of the hubs in Europe, we're seeing a lot more investment coming through, and record number of biotech investments again in the UK. If you look at the past couple of years, so it is improving. It's not there yet. Chinese question is interesting. I mean, I think there is a geopolitical situation that none of us can ignore. And I think that started way before the war, and that has some implications. I mean, the implications are that I think it became obviously very, very difficult for people to do, if any, business with Russia. But also China, I think many people are shying away from Chinese investments. I mean, I remember a few years ago, Chinese were actually very, very active in M&A and investments. And I think it's not the case anymore. I think that's, and in terms of launching in China as a market, of course, that has some implications for biotechs and other companies as well. So it's a difficult situation, but again, we need to see if that's just short term, or is it going to be a long-term situation.
Does anyone else have any comments on that? Okay, we'll move to the next one. Is there a shift to VCs preferring clinical over preclinical stage companies? Jem, do you want to kick off on that one?
Yeah, I think I can gladly take it, and maybe we could also have Özgür's perspective on this one. Actually, we are seeing more and more going into the earlier stage of investments. So probably more focusing on preclinical, and the reason for that is, or I would say phase 1 and preclinical, because all these emerging technologies will hopefully be like, at least some of them will be like a billion-dollar valuation in the coming years. So obvious, and the people are also expecting the fact that the development cycle around these technologies, proven data packages and so on, will come through right after we weather this storm. So actually, it is a bit on the earlier side of the things, rather than going to the more like the clinical or late stage, which is quite interesting. But I guess we can always tie it back to the fact that, as I said, everybody also thinks that science wins at the end. So that's why people are still focusing on this. But I would like to hear Özgür's thoughts as well.
Yeah, I would agree, Jem. I think you said it all. I mean, and just to give you an anecdote, I was speaking to a partner from a fund last week who basically said that they're now incubating some of those preclinical companies themselves. So that suggests to me, which again, I can't name the fund, not to put them on the spot, but it's interesting because you wouldn't think that they would do that. I mean, they're a much later stage investor in everything, and you wouldn't put their name side by side, kind of incubating new companies at the preclinical stage. But there are some funds actually even looking at that right now. So I think it's a mixed bag, and I keep saying the same thing. But there will be some risk. Of course, risk management, right, from investors' point of view. So they might find the clinical companies less risky in some situations. But I don't think there's an overarching rule that suggests that they're shying away from early stage companies.
Thank you.
Thank you. Okay, on to a final question. How do you see the macro environment affecting the CRO industry, especially in the non-clinical and early development? Do you expect to see a slowdown until the funding ramps up again, or do you see it as unrelated and would be offset by private pharma funding? Jem, do you want to take that one?
I think I can, at least I can try, as someone who also worked for a CRO company in the past. I think our perspective is the fact that we see that there are large programs still being run with the CROs. So from that perspective, nothing negative. We also see a lot of developments in the CRO space, such as leveraging decentralized clinical trials to make the clinical trials more effective and productive, to sort of, conduct these clinical trials in a very cost-efficient way. So at this stage, if you looked at the programs already under development and the pipeline coming through the market, it's a healthy mix. So we don't see a lot of impact of it at the moment, and hopefully, with some of the preclinical or phase 1 trials, they are shorter than the other stages in the development life cycle. So once they reach out to phase 2, phase 3, and so on, that they will be also available to the large scale CROs to conduct these trials.
Yeah, and just to add to that, Jam, again, it's a long-term industry, so I think some of that might be a delay effect down the road, because I don't think you would see a lot of impact right now. As we said, there's a lot of cash-rich companies out there. They'll continue doing what they're doing. They'll turn to CROs probably for also cost containment, cost cutting, outsourcing. I mean, all of those dynamics happening already, and I think that will accelerate. And I think there was somewhere in that question, Rebecca, there was non-clinical kind of early stage, which I presume we're talking about more animal studies, preclinical studies, and that space is actually quite specialized, as most people know. I mean, there are not so many CROs doing animal studies. For example, in the UK, it's really few of them doing animal studies. So I don't see how that's going to change in the near future.
Thank you. So that's actually all we've got time for today. A huge thank you to our speakers and for all of you joining us and submitting your questions. Any we haven't answered, we will endeavour to be in touch in due course. If you'd like to speak to us further, please drop a note into the Q&A. We will send the full recording of the webinar out, so do keep an eye out. And we hope to see you all soon on the next Evaluate webinar.
Thank you.